90% of retail traders don't blow up because they're wrong. They blow up because they're right and still bet too big. Before we go further, a quick note. This is educational commentary, not personalized financial advice. Nothing here is a recommendation to buy or sell anything. What I'm going to give you is a mechanism, one number, and the math behind why it decides who survives. Here's the uncomfortable truth. Most traders obsess over entries. Which stock, which strike, which candle pattern. But your entry is maybe 20% of your outcome. The size of the bet is the part that actually kills accounts. You can have a genuinely good strategy and still go to zero if your position sizing is reckless. The market doesn't care that you were right eventually if you're liquidated first. Let me show you why this matters right now. Volatility clusters. When markets get choppy, the same position that felt fine on a calm Tuesday can gap against you overnight. A trader sizing off of best-case scenarios gets destroyed the first time reality delivers a normal, ordinary loss streak. And losing streaks are not rare. They are guaranteed. So let's start with the rule itself, and then I'll defend it with numbers. The rule is simple. Never risk more than 1 to 2% of your account on a single trade. Not 1 to 2% as position size. 1 to 2% as the amount you actually lose if your stop gets hit. That distinction is where most people get it wrong. Here's the mechanism. Say you have a $25,000 account. 1% risk is $250. That is your maximum loss on the trade, full stop. Now suppose you want to buy a stock at $100 with a stop at $95. Your risk per share is $5. 250 divided by 5 equals 50 shares. That's your position. Not a round number you liked, not all the buying power you have. 50 shares, because that's what keeps your loss at 1%. Notice what just happened. The stop distance decided your size, not your conviction. A tight stop lets you hold more shares. A wide stop forces fewer. This is the opposite of how most people trade. They pick a share count first, then slap a stop wherever it feels comfortable, and they have no idea what they're actually risking. Now the part that makes this non-negotiable, the math of drawdowns. Losses and gains are not symmetric. If you lose 10%, you need 11% to get back to even. Lose 20%, you need 25%. Lose 50%, you need 100% gain just to break even. And if you lose 90%, you need a 900% return. The deeper the hole, the more brutal the climb. That asymmetry is the whole game. So watch what 1% risk does for you. To lose half your account risking 1% per trade, you'd need to lose about 69 trades in a row. 69 straight losers. That basically doesn't happen with any strategy worth trading. Now flip it. Risk 10% per trade, and a run of 7 losses in a row cuts your account in half. 7. Every trader hits 7 bad trades in a bad month. One of these traders survives to keep playing. The other is done. Let me make it concrete with 2 traders who have the exact same strategy. Both win 55% of the time. Both make 1.5 times what they risk when they win. Trader A risks 1% a trade. Trader B risks 15% because he wants to get rich this quarter. Over 100 trades, Trader A grinds steadily higher and rides out the rough patches. Trader B has a positive edge and still goes broke because a normal cluster of losses lands while he's oversized. Same edge, opposite outcome. Size was the only variable. For options traders, this gets sharper because your defined risk is often the entire premium. If you buy a call for $2, that whole $200 can go to zero, and it does more often than beginners expect. So your 1% isn't a stop level, it's the full position. On a $25,000 account, 1% is $250, which is barely one contract. That feels painfully small. That feeling is exactly why most options accounts don't last a year. Now let's talk about the trap that beats even people who know this rule, correlation. You put on 5 trades, each risking 1%, and you feel diversified. But they're all long tech, or all short volatility, or all betting the Fed cuts. That's not 5 1% bets. That's one 5% bet wearing a disguise. When the market turns, they all lose together. Real position sizing means sizing your total correlated exposure, not just each ticket in isolation. There's also a psychological dividend here that nobody advertises. When a single trade can only cost you 1%, you stop panicking. You let your stop do its job instead of moving it in fear. You don't revenge trade. You think clearly because no one outcome can hurt you much. Small size doesn't just protect your capital, it protects your decision-making, and your decision-making is the real edge. So what does a disciplined trader actually do? Before entry, they know 3 numbers: account size, dollar risk at 1 to 2%, and stop distance. They divide, they get a share or contract count, and they take that size exactly. Not more because they're confident. Not more because it's a sure thing. There are no sure things. They cap total correlated risk across all open trades, maybe at 5 or 6%. And they treat these numbers as rules, not suggestions, because the whole point of a rule is that it holds on the day you most want to break it. The traders who last aren't the ones with the flashiest wins. They're the ones who are still in the game after the drawdown that wiped everyone else out. Position sizing is boring, and boring is exactly why it works. If this kind of no-hype breakdown is useful to you, subscribe, because we do the math the loud accounts skip. Trade the size that lets you survive to be right. Everything else is just noise.